Well, Prescient's balanced QuantPlus fund has 1.3 billion rands worth of assets under management. For more, the fund's asset manager Jean-Pierre Plessis joins us from our Cape Town studios. Jean-Pierre, thanks very much for your time. Just looking at policy action dictating market action right now, do you think that this is the status quo for some time to come?
Bronwyn, it certainly seems to be the case. The markets are very risk on and risk off. Being buoyed by policymakers' statements, and markets certainly look like they're being driven by the policymakers. We try and stay away from all that kind of noise and focus really on value and what's showing promise in the markets.
Just looking at your balanced fund and the overall philosophy, in good times the fund will perform relatively well, but it's really in tougher times that you are well positioned to cushion any downside exposure. Would that be a fair assessment?
Yes, Bronwyn. The way that we look at risk is we don't see risk as one thing. We see there's two types of risk. One is upside risk and the other is downside risk. Now, what investors want is upside risk, and what nobody wants is downside risk. So what we do is, by using the kind of quantitative process that we have, as well as the derivatives that are available, we eliminate or reduce the downside risk while taking advantage of as much of the upside risk as we can. So you have that nice asymmetry where you take care of the downside, but you still give yourself the opportunity to get that upside.
Looking at your asset allocation at the moment, you're sitting at about 70% exposure across the equity spectrum. Jean-Pierre, is that broken down between local equity plays and international equity plays?
Yes, it is, Bronwyn. The vast majority of that is local equities. We do have some offshore equities, but it is a very small part of the portfolio. We feel that over the longer run, that domestic, I know it's not necessarily the most popular story, but domestic equities offer better value, and that there are more growth opportunities in the South African market.
Now, bearing in mind, as you said, your equity exposure lies mostly within the South African space. Just where in the international spectrum is your offshore equity exposure? Just a little bit more color on that front.
Sure. Our international exposure gets done through our offshore positive return fund, and that fund is very much focused again on getting upside from equities and not having downside. So what we've done in that fund is that we actually have S&P 500 calls, and we're getting our exposure to stocks that way. So our focus in the offshore markets has been in sort of developed offshore markets has been in the US. We also have an allocation to Africa where we think there's a lot of opportunities, and we've done that through our Africa Equity Fund, which uses our equity process to analyze listed equities around the African continent.
Hi, Jean-Pierre, it's Viv Govender here. Just a question on the local market. Over the last few days, you may have noticed that we've been switching. I mean, you can see that the resources have really recovered strongly while after falling for quite a bit, and towards financials and industrials, especially the retail, have come down quite strongly. Do you think this is a longer-term shift that we are seeing, or is it just a short-term reaction to the stimulus news we've been hearing about?
Well, I guess again it comes back down to positioning. The consumer side has had a very, very good run. What our process focuses on is the combination of value as well as momentum. And it's really at that sweet spot between value and momentum that those shares really offer the most, are the best place to be. So what we've seen in those kind of consumer stocks is a very, very strong run, while they still are okay on a momentum basis. From a valuation basis, they look a little stretched, which is why we're underweight them.
In terms of bonds right now, and given the comment earlier that obviously markets are going to be dictated by policy action, how are you feeling about the bond space, and in particular government bonds, Jean-Pierre?
Yes, I mean, we're pretty bearish on government bonds in general. We think that yields are now at levels where they are pretty stretched. We've seen a terrific amount of buying from international investors of our bonds, really in this search for yield, trying to get yield. We know that their home markets are very, very low yields, 1.5% in the US, for example. So they're flooding into our market. But we do see bonds being stretched on a valuation basis. And let's remember that we're also in an environment where the supply of bonds continues to increase. So we're still running budget deficits. The supply of bonds is still increasing. And it's only the kind of flows that we've seen from international investors that have been propping up our bond market. It's the same in the offshore markets. What we've seen is the kind of central policy action, this quantitative easing process that has really supported those bond markets. And without that policy support, it's a little bit unclear, or certainly from a valuation perspective, it appears that the bonds are overvalued.
Hi, Jean-Pierre, Viv again. With regards to your benchmark, I just used the headline CPI. Why did you choose that as opposed to more commonly use the top 40 or some other kind of market-related benchmark? I mean, obviously with inflation being rather low recently, that obviously will affect your benchmark beating. But over time, we wanted to expect the inflation rate to actually have a little correlation to market returns.
Very good question. What we're focused on is producing inflation plus returns. And the reason why we do that is because inflation is really the enemy of any investor. The real value of your pool of savings will go down with that inflation rate. So you want, as a very, very minimum, to be beating inflation in order to see your pot grow. The reason why we do that and we use it in our balanced fund, for example, is that it is a kind of absolute return fund in that we will have from time to time, when pricing is correct, a protection in the fund. So it's not a kind of pure equity fund. It is a balanced asset allocation fund, and it makes sense from our perspective to have that inflation plus target. The other thing is that what we're really trying to do is to beat inflation, but to do it consistently. And it's very easy to say, our benchmark is equities, and equities went down 30%. Well, that doesn't really help the end investor. What the end investor really cares about is making sure that their savings are growing and growing at a rate which is higher than inflation.
What about the listed property spectrum as an asset class? Do you have appetite right now?
We don't. We see valuations a little bit stretched in that sector. Look, it's been on a terrific run, very much driven by that search for yield that we've seen in the bond markets. We still think that there's a lot of headwinds in that sector, and as a result, we've stayed away from that sector for now.
Any further questions from you, Viv?
One final thing. I mean, generally, as a market kind of commentator, what are you thinking about the current QE kind of announcements that we're expecting from the US and regarding the ECB? Is this something that you think may last a bit of time, or is the effect wearing out?
Well, it's a very interesting question, and probably one that could have its own program. But what we've seen is the dramatic impact of QE1 in the States, followed by QE2, which had a much lesser impact. And I think the jury is still out on QE3. I know this is controversial, but I think it's the jury is still out on QE3 purely because it's hard to tell what impact that's really going to have in markets and really spurring growth onwards. I think from the Fed's perspective, the worst thing that could possibly happen is that they do QE3 and the market kind of yawns, and there's no follow through from the implementation of QE3. So that's really the risk of implementing it. The other thing is we are living in a policy experiment. And we don't really know how this quantitative easing process, whether it's what's been done in the US or in Europe, how that's actually going to, what impact that's going to have in terms of markets and economies going forward. And I think the Fed will be a little bit concerned, or at least be cautious, because they're not entirely sure how this plays out over the medium to longer term.